Hey, welcome to the show. Today we're going to talk about the Fed, the US central bank, and whether or not the Fed is scared of crypto. Hello, I'm Molly Elmore with Clever Hummingbird, and today we're going to talk about the Fed and central banks and whether or not they are scared of crypto. So, when I first got into understanding and learning about crypto a while ago, it was positioned to me as this alternative to banking. That if I wanted to be my own bank and sort of get out of this traditional banking system, I could learn about these digital assets, I could lend them out, I could make money, I could become my own bank. It was positioned as a direct threat to the banking system, which at the time sounded really appealing because I had read Creature from Jekyll Island, which influenced me tremendously and was sort of under the impression that central banks were sort of this cancer on society and contribute nothing positive. I'm still no fan of central banks. However, I have learned since then that it is not that simple and that the central banks of the world are sort of factions of a global money political cartel. They all have their interests to protect. They're full of good and bad people. And if when you try to look in this label of one group is good and one group is bad, it doesn't really give you the big picture. I would assume that none of them are good. They all have specific agenda or motives that they're looking to protect, and sometimes they get in fights with each other as in sort of a pursuit of more power. Now, in terms of whether or not the Fed fears crypto, again, it's not that simple. We're going to dig into that today. And before we talk about any crypto specific assets, I want to talk more about the Fed and about banking. All right. The Fed is a central bank, but it is unique relative to other central banks in the world, and it is the issuer of the primary global reserve currency. So that is a unique power and responsibility that the US central bank has. In exchange for that privilege or power, whatever you want to call it, the US since 1944 has taken on the role of being the kind of global supply chain cop and make sure that ships shipping widgets from China to wherever are not being hijacked on the open seas. And that's sort of, I think, what the initial logic was for why the US was able to profit so much from this arrangement was that they took that profit and they built out this military that kept the global supply chain protected. Because after World War II, countries like Germany and Japan were absolutely devastated, and they rebuilt by selling stuff to Americans, and the US military ensured that that supply chain was kept intact. However, not everyone is thrilled with that arrangement, and it does give the Fed a unique advantage in that it is the only group, if everything is priced in dollars, and the Fed is the only group that can literally print money out of nothing, they have the power to print bank reserves, which are a little bit different than actual money that you and I would spend. But even though other central banks can print their own reserves as well, if everything is bought in dollars, their reserves are they're never going to have the same level of value that the primary global reserve currency will have. So the Fed is a private business. They have shareholders. And if you look at them through the lens of a private company that just has a deal with the government, they kind of are a government contractor of sorts, but their deal is sort of written in by Congress and it's been in place for a long time. And they have specific power to print money, to issue currency, issue reserves, and to manage some things like interest rates. They have a dual mandate to keep unemployment low and inflation low, which is often a conflict because to increase one or to preserve one, you have to sacrifice the other. So it's not a particularly easy challenge to handle. However, if you think about the Fed as a business, they have a product. The product is the US dollar. And for all intents and purposes, their entire agenda will be to primarily protect that product and to maintain control of that product so that it can serve the interests of its shareholders, which are a group of large commercial banks. If you've read The Creature from Jekyll Island, I'm going to just go off the assumption that that is factual. Back in 1913, there was a meeting at Jekyll Island in Georgia, and at a private hotel. It was kind of a secret meeting, and a group of bankers and sort of representative of banks met to create this plan for the Federal Reserve System, which is 12 different banks that kind of work together in some capacity. We don't know exactly the percentages of like who owns how much of it. It is believed that the New York Fed has more power and influence than any of the other members, but I don't really know how to prove that. So we'll just kind of go off that assumption that the large commercial banks, what we'll call Wall Street, are extremely influential in what the Fed does, and that the Fed will serve the interests of the New York commercial banks, JP Morgan, except Citibank, Bank of America, those types of banks. It will protect their interests primarily and protect control over their one product, which is the dollar. All right, let's talk about how banks make money. Many banks have a variety of different products and services, but ultimately, banking is fairly simple. They issue loans and they charge interest on those loans. Let's use a very basic example. Let's say I go down to my neighborhood bank, I deposit $100 in the bank. The bank would then take that money and they would go lend it to somebody who wants to start a business or buy a house or whatever, and charge interest on that. And then when the loan gets repaid, my money's now back there in case I need to go and take it out and go do something else with it. Extremely simplistic model of banking, but it's pretty much understood that when I go and deposit money in the bank, it's not just going to sit there. Like the bank is going to use that money in some capacity to make money. That is their business model. So if you think about what is the threat of the crypto world, or what are banks looking to protect primarily, they don't want anybody messing with their system of issuing loans. They want to issue loans to people, to companies, even to other countries through sovereign debt and bond buying. I don't think crypto, the vast majority of it, is really messing with banks' ability to issue loans to the vast majority of people. And if you even think about credit cards, that's probably one of the most common ways that banks issue loans to people on a regular basis is by giving you a line of credit. You can go out and buy whatever you want with it. If you don't pay it back right away, you have to pay interest on it. Now, the truly genius part of this business model is that they are able to issue loans that exceed what people deposited in the bank. Now, it used to be that you had to, this was my impression at least, you had to have at least 10% of the money in reserve. So if I put $10 in the bank could then go and lend $100 to somebody and charge interest off the $100. And this is how the money supply gets increased, is every time a commercial bank issues a loan and they use fractional reserve lending, they are now creating money out of nothing, because I only put $10 in the bank, but now $100 got loaned out. That $90 is new money, and that money stays in the system because I'm going to go spend it at the grocery store, and then that grocery store is going to take it to pay their employee, and that employee is going to take it to pay rent, et cetera. And it continues on throughout the economy. Even when I pay back that credit card and that debt is now wiped, that money still exists as value in the system, which is how, one of the ways that the money supply gets increased. Now, what was remarkable was in 2020, not a lot of people noticed this, but I had just read the book about it, so I kind of noticed maybe more than others might have. But they reduced that reserve requirement to zero. So a bank could now issue a loan without having to have any of the money in reserves, which is quite remarkable. So that's like literally the most scalable business in the world. I can lend you something that doesn't exist, and if you don't pay me back right away, I'm going to charge you interest on it. And if you fail to do that, I'm going to punish you by dinging your credit score. It's quite ingenious, actually. And that's why when people default on loans, I'm not even really sure why banks get all mad about it, because money didn't exist in the first place. And that's where this sort of student loan forgiveness thing is a little silly too, because how much of those loans that are issued were created out of nothing, and they're charging people interest on nothing, and then saying, oh, we're so generous, we're going to forgive this debt, but it was created out of nothing. Now, I know that people get heated talking about that topic, but I don't think that it's as generous as it may appear because the money was created when those loans were issued. Now, it is possible that a small, percentage was based on reserves that did exist and that needs to get paid back, but the majority of those loans are created from nothing. And so if they're wiped from existence before they're paid back, in theory, that does kind of help reduce the money supply, which helps with inflation. But the thing I'm not fully clear on is that money got spent. That school took that money, they built some big fancy building or built a new computer center or whatever, and that money is now still out there in the economy. So they have to sort of get it out of the economy and kind of burn the tokens like they do talk about in crypto. So back to what crypto is as a threat to banking. Uh, Most crypto uses and tokens really have nothing to do with banks issuing loans via credit cards, mortgages, car loans, etc., which is the majority of the ways that they make money. Now, banks do make money sending money to other banks around the country. This is called the payments and settlement space. This is kind of where Ripple gets involved. And there is money with these correspondent banks, but if you think about sort of the fundamental concept with banking, their real business model is loans via US dollars. So that is what's going to be their primary interest to protect. If we look at some of these major digital assets, Bitcoin is primarily a way to send money from one person to another without having to go through an intermediary. It doesn't really have anything to do with loans that would threaten the banking industry. It also could be a store of value, which we'll still see in the long term how well Bitcoin holds up. I love the idea in theory, but I do know that all of these markets can be manipulated. So if the powers that be that are in a position to manipulate markets don't want Bitcoin to be a store of value, I'm not sure we can overcome that. I don't think they could kill Bitcoin or get rid of it, but they could make it illegal for people and they could make it even a crime to transact in Bitcoin. They could also, that would be done at the nation level. So depending on where you live, I think that would be an issue potentially. They could also make it very difficult for you to spend it. So there are ways, even if the ledger and the code exists and people are able to transact in it, the governments of the world could make it very difficult for it to be valued and used. Ethereum, similar thing. I don't see it as a threat at all to banking. It's not really messing around with loans. Now, XRP and Ripple specifically have relationships with banks, so they want to help banks send money around the globe via their payments offer and their liquidity pool ODL. They want to help the banks make more money by sending money quicker and reducing this need for Nostra Vostra accounts and making things more efficient. So I don't see XRP or the Ripple's use of XRP being a threat to banking at all. Dogecoin is kind of funny. I'm still not really clear why Elon Musk is so fascinated with it. I don't know if it's sort of trolling the world or if there is some place for Doge in the future. It's not really one of my areas of focus, but it is considered a digital asset. Tether, however, is a very different animal. Tether is a stable coin. Tether does represent a threat to the Fed because Tether is using the Fed's product, which is US dollars, outside of the banking system. So if Tether wants to employ fractional reserve banking and issue more dollars than they have in reserves, that is a problem because now the Fed does not have control over the supply. They can't force Tether to put money into the reverse repo market. And those dollars could be leveraged at an infinite rate for all we know. Now, Circle is considered kind of a favorite with the Wall Street crowd because they are kind of part of that world, and it is believed they are very well collateralized. And I think the takeaway from that is that Circle is not increasing the supply of dollars, which is very important to understand. If you want to take dollars that exist, kind of park them somewhere, and then create kind of what's called a wrapped token, like a mirror token, literally like a poker chip that has a 1-to-1 ratio, then that's not really a threat to the Fed, in my opinion, because they're not messing around with the supply of dollars. Tether is very different. And actually, Terra Luna is remarkably different because Terra's product UST was not collateralized to any dollars. They had collateralized it to other assets, which who cares if you're the Fed? They were literally creating dollars out of nothing. Now, it was no big deal as long as those dollars stayed in crypto land and you just used them to buy NFTs or some other in crypto land thing. But what I'm not sure a lot of people are aware of, because I was pretty deep into that world, I thought the technology was pretty cool. And I loved the idea that they were creating stable coins everywhere because I didn't understand this issue that we're talking about here back then. A couple weeks before Terra was taken out, I no doubt they were taken out, a new service came online that some people I knew started to use. It was called Alice Finance. And what Alice would let you do is take your Luna. Let's say you had a bunch of Luna and you staked it and you got rewards, you got paid this profit. You could take that Luna, convert it to UST, and right within the Alice app, which kind of lived on your phone, you could go to a store and buy stuff with it. You weren't going through central exchange. You weren't switching it back to fiat. You were literally spending UST out in the real world. This was huge because now dollars were being created outside of the banking system. Dollars were being created in crypto land. An infinite number could be created if Terra had continued to thrive. And now in the real world, the money supply was being increased outside of the control of the Fed. It was like 2 weeks later that the Terra was taken out. And I thought it was really about the control of the on and off ramps, but that's not really it, in my opinion, at this point. I think it's less about that as much as control over who gets to print more dollars. That is a privilege that the Fed has and the member banks. If you have to be a licensed bank in the US to do that. Because the reason why this makes so much sense to me is because there is another entity, loosely called an entity in the world, that is also a threat to the Fed, and it is called the Eurodollar market. And I do have a video that I did about this market. I'll put that in the description if you're interested in kind of digging in deeper. But the Eurodollar market is nothing to do with the euro. It has actually nothing to do with Europe. It's essentially all dollars that are stored outside of the US banking system that get lent out using fractional reserve lending. So back in the 40s, Japan makes all these widgets to sell to Americans. They have this profit. They take this profit and what are they going to do with it? They can switch it back to yen so they can spend it in Japan, but they didn't need all of it. And they knew they were going to have to buy stuff in the supply chain in dollars. So why do that? So instead, what they could do is they could take those dollars that were profit and deposit them in a bank, not in a US bank. They were going to deposit them in a bank in Europe originally. And the bank in Europe would take these dollars and they would issue loans to other people in dollars because dollar is a strong, stable currency. So why not make your profit in dollars? So if I issue you a loan in dollars and I charge you interest in dollars, I get to be like a US bank and make my profit in dollars. And I'm now a bank printing dollars out of nothing, just like one of these US banks that's a member of the Fed. And I'm not regulated by US rules or laws. I'm not regulated by the Fed because I'm a random bank in Europe or a random bank in the Caribbean. I can do whatever I want. I could take the riskiest loans in the world. I could leverage 1 billion times. Like, I don't have any of these rules that the US banks have. So what has happened over the last couple of decades is that the Eurodollar market, also called the offshore dollar market, has massively increased the supply of dollars. And this has resulted in the Fed not really being in control of the dollar. I mean, one thing that the Fed does if too much money is in circulation is they use this thing called the repo facility, which is basically telling the banks, hey, JP Morgan, there's too much money. I want you to go park it in my vault. I'm going to pay you interest so that you're not feeling like you're losing out on investing. And the repo money in there is a lot right now, and they're paying interest as a way to keep that money out of the spendable supply. In theory, this would help with inflation because you're now reducing the supply of dollars. They're not destroying them. You're not like burning the tokens. You're just sort of parking them they're out of commission. They can't do that with the Eurodollar market because these banks are not part of that. And they certainly can't force a bank outside of it. Now, if you look at, I did also a separate video on this sort of war between the Fed and the European oligarchs who want to return us all to feudalism and have this sort of nefarious Great Reset agenda. The way they're paying for their agenda is through issuing money via the Eurodollar market. They're taking out leverage loans to pay for stuff. So the Fed is actively, and this is really Tom Luongo's thesis, which I have studied quite a bit and happen to agree with. But the Fed is raising rates, not really because they care about inflation, but because they want to bankrupt the offshore Eurodollar markets. They want to stop all of this lending that's going on outside of their control, take back control of the dollar, and shut down this Great Reset agenda. They're just going to bankrupt them. And how would that actually work? Well, let's say you're a bank somewhere in Europe, whatever, because a lot of these European Davos crowd, they actually own banks. So let's say you're one of these European banks and I'm issuing loans to some third world country that can't really afford it, but I issue them the loan anyway. And now the Fed's raising rates. So if you've noticed, the value of the dollar has gone up a lot relative to a lot of these other currencies. So these other nations aren't able to make the payments because the value of the dollar means the exchange rate's not in their favor and their payments cost a lot. So they're not able to service the debt and they're going to default. So it's going to create all these problems for these European banks who the little bit of collateral that they did have, they're not going to get back. And now the Great Reset doesn't have enough money to pay people off, buy media, all the stuff that they have to do. So that's sort of part of this thesis from Tom, that the Fed is fighting against the Eurodollar market because they want to bankrupt Davos and reclaim control of the dollar. And the exact same thing is happening with stablecoins. If you dig into what happened with FTX, FTX was also being used kind of like the Eurodollar market, where I put a little bit of money in, you take out this, create this new token, you pump up the value of the token. Now I can take out a loan with this token as collateral, but the token didn't really exist. It wasn't actually real value. You're basically creating a loan out of nothing. I swap that loan back to some kind of stable coin, boom, cash it out, and I can spend it in the real world. So they had this system where they were doing a form of fractional reserve lending within FTX to create new money out of nothing to pay for all sorts of shady things, paying off politicians, all that kind of stuff. And the Fed doesn't like that. So it comes to the question of whether or not FTX was taken out to shut down this sort of modern version of the Eurodollar market that was going on within crypto. Because that's sort of the thing that high interest rates will do, is they will increase the value of the dollar and force a lot of people to default on their loans, which means that all of these very risky loans that are being issued outside of the US banking system, the rate of default is going to be very high, and that will cause that system to collapse of sorts. Now, the interesting next step to see is whether or not crypto regulation will basically become stablecoin regulation. I want to play a clip for you of Jerome Powell. The only one I could find was from a Spanish media something, and so it has Spanish subtitles, but the clip itself is in English. So hold on, let's watch that.
Is it your intention to ban or limit the use of cryptocurrencies like we're seeing in China?
No, central bank digital currencies could perform could make,
but no intention to ban.
Less.
No intention to ban.
No intention to ban them, but they're, the stable coins are like money market funds. They're like bank deposits, but they're to some extent outside the regulatory perimeter, and it's appropriate that they be regulated. Same activity, same regulation.
So as you can see, he mentioned that stablecoins should be regulated, and no intention or interest to ban Bitcoin specifically, because it's just not something they care about. The issue is stablecoins, and it's not really about control of the on-ramp and off-ramp. my opinion, it is more about leverage, and the threat is when other entities that are outside of the regulated banking system start issuing new dollars. That is a problem for the Fed. They do not want that. It is you're messing around with their product, and they will use whatever tools they have to respond to that accordingly. So looking through this lens, it makes you wonder, Terra issuing dollars outside of the thing. Celsius was also a lender. FTX was also a lender. Is this war on crypto really have anything to do with crypto at all, or as much of the fact that we now have a new offshore dollar market where dollars are getting printed out of nothing? So that, to me, I think is a very interesting angle on this. So the Fed, I don't think, is threatened by crypto, but it is threatened by digital asset lending that is being done outside the banking system. And that's what I think is going on. So if you like this video, if you enjoyed this video, please like it. I appreciate that. Subscribe to the channel to get some more updates for when next time, and I'll see you in the next video.